All right, let's get right into it. Today, we are tackling a question that could literally save you thousands of dollars. How much does renter's insurance actually cost? We're going to break down the numbers, the hidden factors you might not know about, and yeah, the simple tricks to getting the best deal possible. So let's just start with the big question. When you think about protecting everything you own, your laptop, your couch, all your clothes, what's the number that pops into your head? What's the real price tag for that peace of mind, for knowing that if something awful happens, you're covered? How about this number? $15. Seriously, seems almost too low, right? That's probably less than you're paying for Netflix or Spotify. And that's the key phrase right there. Per month on average. That's our baseline. It's the starting point for this whole conversation. And while it's super affordable, as you're about to see, that $15 number is really just the beginning of the story. Okay, so while 15 bucks a month is a great ballpark figure to have in your head, the reality, it's a little more complex. So let's look at the national averages from a few different places to get a much clearer picture of what most people are actually paying. So, most studies put the average annual cost somewhere between $150 and $200. If you break that down, you're looking at about $13 to $23 a month. And for that price, a standard policy usually covers around $30,000 of your personal stuff. Think about that. For less than the cost of a couple of movie tickets, you're protecting tens of thousands of dollars worth of your belongings. And now, we get to the single biggest factor that shapes your price. It's not how much fancy stuff you have, it's not even your credit score, it is your zip code. Where you live can totally change your insurance bill, and you're about to see just how dramatic it can be. Whoa, okay, this really puts it in perspective. Just look at this. The average premium in Louisiana is more than double what it is in North Dakota. So why the huge difference? Well, it all comes down to risk. States that get hit with hurricanes and major thunderstorms just have a higher chance of claims, so insurance costs more. It's a direct reflection of the local weather and risks. So that huge difference between states just shows you how much location matters. But your address is only one piece of the puzzle. Insurers look at a whole bunch of other things to figure out your personal risk profile, and it pretty much boils down to 8 key areas. Let's break them down. Okay, so we've already covered location, but here's what else they're looking at. How much coverage you want, your deductible, and we'll explain that in a sec, your credit history, your claims history, the safety features in your building, whether you bundle with other policies, and a few other personal details. This is basically the checklist they use to figure out how likely you are to file a claim. Now, this one's pretty straightforward. The more stuff you insure, the more it costs. But here's the detail that really matters: how your stuff gets replaced. You've got 2 main options: actual cash value, which pays you what your 5-year-old laptop is worth today, with depreciation. Or there's replacement cost, which gives you enough money to go out and buy a brand new equivalent. Replacement cost is a little bit more expensive, but man, it can make a huge difference if you ever need it.
All right, next up is the deductible. This is a really important one to understand. Just think of it as your share of the bill. It's the amount of money you have to pay yourself out of your own pocket before the insurance company starts kicking in their money.
And here's the trade-off, the deal you make with the insurance company. If you agree to a higher deductible, say $1,000 instead of $500, they see you as less of a risk for small claims. So what do? They charge you a lower monthly premium. It's a balancing act. Do you want to pay less now every month or pay less later if you have to file a claim? Now, this one might actually surprise you: the massive effect of your credit history. In most states, insurers use a credit-based score to predict risk. And the data shows that someone with poor credit pays, on average, 71% more than someone with good credit. We're talking over $100 more per year for the exact same coverage. That's a huge difference. Your personal history with insurance also plays a big part. So if you filed a claim recently, insurers kind of see you as more likely to file another one. Just having one recent theft claim on your record, for example, can bump up your average annual premium by about 18%. But hey, it's not all doom and gloom and things that raise your rate. Insurers will actually reward you for being less of a risk. If your apartment has good deadbolts, a fire alarm system, or sprinklers, you can often get some really nice discounts because your home is just considered safer. Okay, so now that we get what drives the cost, let's flip the script and talk about what you can do about it. This is your game plan, your playbook for actively lowering that premium and getting the absolute most for your money. It really comes down to 4 simple, powerful steps. First, and I can't say this enough, shop around. Second,
Optimize your coverage. Make sure you have the right amount and the right type. Third, you have to be your own advocate and ask for every single discount you might qualify for. And finally, if you can, work on improving that credit score.
Let's just focus on that first step for a second, because it is by far the most important one. Premiums for the exact same coverage can vary by hundreds of dollars from one company to another. You absolutely have to get quotes from at least 3 different insurers. It's the only way to know for sure you're not overpaying. And here is one of the easiest discounts in the book. If you already have car insurance, call that company first. By bundling your renters and auto policies together, you can often save anywhere from 5 to 15% on your total bill. It's just one simple phone call that could save you real money. So we've talked a lot about the cost, the factors, the savings, but let's kind of pull back and bring it all together and ask the most important question of all. After everything we've gone through, what's the verdict? Is it actually worth that $15 or $20 a month? Does the protection you get really justify the cost? Well, here's what that small monthly payment is really buying you. It's protecting all your stuff if it gets stolen or destroyed in a fire. It's protecting your finances if someone gets hurt in your apartment and decides to sue you. And it protects your stability, covering things like hotel bills if a disaster forces you out of your home. It's a financial safety net for some of life's absolute worst-case scenarios. So we'll end with this thought. You know what your stuff is worth. You can add it all up. But the real question is, what's your peace of mind worth? For the cost of a few coffees a month, you're not just buying a policy, you're buying security. And that's something to think about.